Good morning. Welcome to the XM.com weekly market update, and we're joined again by Peter McGuire, the CEO of XM. Good morning, Pete.
Good morning, Andrew.
Let's have a look at the domestic market. Initially, not too much going on the domestic front. The Aussie dollar 64.30 recovered ever so slightly from last week, but
Absolutely.
still under plenty of pressure, particularly of what's going on in China.
Yeah, well, it seems to be a one-way traffic, and as you mentioned, it did bounce, and that US dollar has certainly had a nice run up. So the other side of it, of course, is the Aussie was sold off, and the storyline with China, it seems to be gaining momentum as far as bad news.
Yeah, and I think there's plenty of work to be done. So if we look at the next couple of slides as well, we look at this loan growth. Now, sure, that goes back to pre-GFC, so
Yes.
Obviously that spike is understandable around the GFC, but ever since then, and even if you look back just over the last sort of 6 or 7 years, the growth has been steadily going down, but there's the concerns around where that growth is and the financial companies in China
And shadow banking.
And the shadow banking as well, which no one really has a lot of visibility over.
No, exactly, and it's opaque, and the transparency issue is very, I think on every trader's mindset, they want to see that, and certainly the people holding the debt and how that's all being massaged through, and the sentiment moving forward. Yeah, September's going to be an interesting month.
Yeah, and I think so much of that debt is in the property market, which we know is under a huge amount of pressure.
Absolutely, and then it comes, and we will cover it, but the debt to GDP levels are just at astronomical.
Yeah, well, we look at that chart now, which is massive, and the Chinese government certainly got a tough gig on their hands at the moment to try and rein this in, but I think gone are the days of massive infrastructure spending, particularly on property, because there's such.
It's all done, seems to be.
Exactly. So, how they manage this, time will tell. But once again, that is obviously, as we said, is putting a lot of pressure on the Aussie dollar.
Yeah, exactly. And once you start approaching 300%, this is mayhem. So it's going to be hard for them to wriggle their way out of this one.
Yeah, for sure. And once again, just looking at the equity markets in China, both the Shenzhen and the Hang Seng, they're pretty much flat for the year. So, which is interesting when you look at how the US has performed, the equity side of things, as well as Japan, which have had fantastic years.
Yeah, first 8 months have just boomed.
Yeah, but these are both flat, so not a lot of love in the equity markets either.
No, exactly. That CSI 300, we thought it had bounced, but it certainly hasn't bounced. It's been channeled and it's just sideways, around that 38 to 4,000 sort of level. And the Hang Seng, well, that's out of Hong Kong, and that's actually, not only underperforming, but declining.
Over to the Eurozone, once again, issues over there. We look at the GDP, which is just bouncing pretty much close to zero at the moment, and it has done for a few quarters. And the PMI numbers are not flash either.
No.
So plenty of work still to be done to try and reinvigorate the Eurozone.
Yeah, well, the storyline coming out of Germany, and we all understand that's the powerhouse of Europe. If that's in decline, which it certainly is, then that creates much angst for a chart like that. And at 46.5, anything under 50 is contraction, and we've got that running at about 46, 47. That Eurozone composite PMI. We've got data coming out this week, so all of that taken on board is not a good sign, and is that contagion? Just put your mind around it. First off, China really hemorrhaged. Eurozone, absolutely underwater. Well, what's left? You're talking about developed world here, second largest economy, and then the Eurozone with 500 million inhabitants and consumers. It's not looking good. So, I'm not sure how the rest of 23 plays out, or rolling into 24. You can't just have one country, being US equities, the growth engine, considering that they earn 40 to 60% of their income offshore.
Yeah, now it's interesting, and I know we've spoken about it previously, just that resilience of the US market and the US consumer is extraordinary.
I'm still holding my view. We're 4 months out, and I'm still holding on. I'm not going to share it with you. I'll share it with you on the 31st of December. So hold tight, folks. 4 months to go.
Have a recap. All right, once again, just a quick look at the euro. It's sort of like under pressure, but it's sort of hanging in there to a certain extent. So
yes, it is around that 108 sort of number. It's been dynamic to trade. It's been very exciting. So where it runs from here, maybe a little bit further softness. I'm not sure, but that US dollar through 104 I'm not sure whether we're going to see parity again. Just have to wait and see.
Yeah, but you would sort of think with the euro, the CPI is still pretty sticky at above 5%. So you would suspect they've probably got, you would think at least 2 or 3 rate rises left in them.
Yeah, which is going to be catastrophic for their domestic economy.
Yeah, for sure. Just quickly, gold hit over 2,000 back in May of this year.
Yeah, bounced nicely.
Yeah, it's come off, not massively, but it has, that euphoria has subsided somewhat.
Yeah, 1950 at the moment. US dollar strengthened considerably. And while you're getting rates up, and Jay Powell coming out on Friday night as far as Jackson Hole, and he hasn't finished raising rates, that's the storyline. You might even get another one in September for the Fed. So this has all got to be factored into the market and the impact it has naturally, US dollar index and gold, and what happens as far as higher yields to the stock market. So it's the last 4 months are going to be quite exciting.
Yeah, you're right. And the interest rates are certain. They don't look. Well, they're certainly not going to be coming off quickly in the US. That's for sure. So, finally, just an equity chart.
I love these charts.
So this is, once again, you hear it a lot around either time in the market or timing the market, and pretty much everyone says timing the market is virtually impossiable.
Yes.
So if we look at timing,
well, there's
the market,
a degree of luck of that.
Well, of course there is. Yes. So, but once again, it's incredible. You look at this for over what's that, a 30-year period? No, 40-year period, sorry.
Yes.
10,000 invested. If you put it in, don't touch it.
Yep.
You come out on top.
Exactly. There's no doubting that. I mean, we've got and I'll just put a timestamp on that. As far as traders are a different mentality, and that is short term, and remember that the market never sleeps. So you're talking 24 hours a day for, let's say, currencies or commodities and possibly stock indexes. But they're looking at technicals. They're really looking at close range charts over the last 5 minutes or the last 15 minutes. Whereas the majority of people, if you've got an office job or you're a doctor or a dentist, you're not following. You're following what happened tomorrow, tomorrow's news via the newspaper. Oh, the market went up. Versus a trader that's living and breathing it on a hot desk of information, seasonality, what's going on with economic conditions, and fundamental analysis coming out and being spat out by the minute, and you're looking at your charts and navigating. So, I do agree with you.
But I think it's interesting that technical analysis, fundamental analysis, all the different charts and whatnot, I think are very much in play for commodity trading, futures trading, currency trading. I think for straight equities, probably not so much.
No, well,
at the end of the day, the straight equities, the bottom line is if your company is improving their earnings, improving the EPS, then in theory, the share price will go up. So yes, you can look at charts, technical analysis on straight equities, but I think it's more in the other type of trading products that really comes into play.
Those instruments.
Yeah, for sure. But no, once again, it's a really interesting chart. Like even that one, only missing 5 of the best days, and you lose out by $265,000. It's extraordinary.
It is really extraordinary. The numbers say it all. I mean, you don't have to really add much rhetoric to it. That's for the viewers to take on board and really appreciate. And thank you for posting that, Andrew, because that is reality. There's nowhere to hide with that.
No, and they're not cherry picking a certain date. It's a 40-year, and I know like fund managers can cherry pick dates to make returns look very good. So, but that's a blanket 40 years. So patience is the key.
Very true. Yeah, 100%. I agree with you.
It's certainly a good one to look at.
Hopefully the next 40 years are as good, because we'll be here in 40 years' time, you and I, and I'm looking forward to that, Andrew.
We might be propped up, but yes. Time will tell. Anyway, so that's a wrap again. So thanks for coming in, Pete.
Oh, lovely to see you, Andrew.
We'll see you next week.
All right, look forward to it.
And that's the xm.com weekly market update.